bring in Eser Ozdil, a non-resident fellow at the Atlantic Council. Good to speak to you. Now, why are markets so quick to price out risk, even as tensions are still clearly in play here?
Well, there are several factors, but in the first, I think we need to assess the behaviors of the markets. Markets often appear to price out geopolitical risk surprisingly quickly, but that doesn't mean that investors believe the underlying problems have disappeared. Financial markets generally tend to price the change in risk rather than the absolute level of the risk. For example, if traders were worried about the closure of the Strait of Hormuz, even like a 20% probability, then basically the oil prices and the asset prices could rise very, very sharply. And then we need to talk about a couple of several factors. There are historical experiences, of course, in the minds of the traders. Most geopolitical crises in the past didn't allow into worst-case scenarios. Generally, investors have repeatedly seen conflicts flare up and destabilize before causing lasting global economic damage. And from the market structure point of view, hedge funds and algorithmic traders react information very, very rapidly. And once the worst-case scenario becomes less likely, short positions are covered and risk assets rebound rapidly. So that's why for the short-term period of time, the market traders doesn't think that the situation will evolve to the worst-case scenario. And last but not least, the temporary removal of the sanctions on Iran, and is Iran able to supply oil to global markets? This is another key development from supply point of view, and in combination of all these factors caused a very rapid decrease in global oil prices.
Now, traders seem to be betting on a return to normalcy, but is that possible given the structural damage to Middle Eastern infrastructure that might take years to fix?
That's true. However, the most of the infrastructure damage is on the LNG side, so that's why we will not see very clear increase in the LNG damages. However, in the oil side, so many Gulf countries still have untapped reserves, as well as the potentials are not 100% utilized. So that's why in a supply and demand balance, most traders are in the positive side. So that's why we have seen a very sharp decrease in the prices.
Now, looking at Russia, it's now facing fuel shortages during its harvest season. So is Ukraine's drone campaign now becoming a more effective weapon against the Kremlin's economy than sanctions ever were?
The thing is that sanctions have unquestionably constrained Russia's economy. They have higher financial costs. Definitely, technology imports reduced substantially. That created huge new dependency to the alternative trade routes for Russia, especially to China. And there is substantial long-term productivity losses. However, during the oil shortages, Russia had received a temporary license to export oil and gas products, and that increased Russia's income. The position of Ukraine right now to damage the critical infrastructure of Russia in order to force Russian government to come to the negotiation table. So yes, in short, it seems more effective than the sanctions.
And we're hearing that the OECD's emergency oil stocks have plummeted to their lowest level since 1990. Is this US-Iran true? If it falls, does the West have any strategic buffers left to contain a second price spike?
For short term, no. For the long term, it might be. Still, the vulnerability is big. When we look at the historical strategic reserves of the OECD countries, yes, there have been so many crises. However, right now, this is the lowest level in the consideration of the international markets. However, still there are remaining strategic petroleum reserves on the storages. And two, there is spare production capacity from key Gulf producers, especially Saudi Arabia, Kuwait, Iraq, and UAE. And in the meantime, we have seen during the crisis that North American production have increased, and still there is spare capacity to further increase in the North American production. Demand destruction caused by higher prices. This is market reality. And still governments have certain financial tools to policy interventions such as fuel taxes, stock releases, export adjustments, etc. However, still the Hormuz Strait crisis is very sensitive. And if another large-scale military campaign happens, and again, if we see the closure of the Hormuz Strait, yes, another price plunge is quite possible.
Eser Ozdil, non-resident fellow at the Atlantic Council, thank you for speaking to us on TRT World.